Good morning. I'm Lex, your host. This is Options Brew TV. Today, we are going to be talking with Mr. Matt Cashman of the OIC. We're going to let him explain what all that means. And we're also going to hit on SKEW a little bit today. Options SKEW. Super important concept to understand, and Matt's going to break it down for us. So stay tuned for this great show. Matt,
what's happening, Lex?
Oh, not much. Good to see you as always, man. I always love having you on. This is a treat. Two old SIBO floor traders, right?
We're just old dinosaurs hanging out together, talking about options, dude.
I know. I love it. At least we're still in the industry. You know, a lot of people left. They're selling real estate. You know, and
yes,
we're still banging around.
And/or we're shown the door. Right? Both of those happened. But you, I mean. You know, you are wearing a sport coat today, which is very nice.
I dressed up for you because you're the man. So
yeah. It's on my account. I love it.
It's on your account. Yeah, I know. I didn't wear the coolest shirt in the world, but it's you know.
I mean, you're pretty cool as far as guys are involved in the industry and your role are. You're a pretty cool guy.
Yeah, I've been world traveling too. So we're doing all kinds of summits around the country.
Yeah.
Back in action doing live speaking engagements. So you know those well, I'm sure. So
yeah. Where was the last place you were?
I just got back from out in Orlando.
Ooh.
Yeah. It was nice.
Orlando. Beautiful Orlando. Was it 85 degrees and sunny?
Not quite. It was 67 and sunny.
That's not bad.
Which is better. So I like that a lot. That was pretty good. You go so OIC, the other OIC, the one in Nashville, that's coming up too.
Yeah, that's the options conference.
Yeah,
I don't think I'm going to be there, but someone from our team will be there. And that's always a great conference and lots of amazing content, lots of amazing speakers. And the woman who puts it all together, named Trisha Pearl, is a colleague of mine, sits right next to me on the investor education desk. And she is incredible at what she does. And she does a fantastic job of putting that whole conference together. So it'll be amazing, I'm sure.
Yeah, I know Trisha from that conference, actually. So we
she is tireless in what she does, and she's really good at it, and she does a good job. So
perfect. Looking forward to it.
Yeah.
Okay, so we're going to talk about SKEW today, right?
Yeah, man. Let's talk about SKEW.
Okay, so first things first, right? SKEW. And we use that word in reference to options in the curve of an expiration, and even kind of the relationship of implied volatilities across term structure to some degree. So I'm gonna let you take it over. You start walking us down the path.
All right.
And then I'm gonna ask questions because I think I've been around long enough to experience when SKEW didn't exist. So. Whoa. Yeah, I was one of the pre-87 guys. So,
holy cow.
Yeah, right. Think about that. That's nuts, right?
Well, yeah. I mean, that's a perfect segue into talking about what SKEW is, because honestly, SKEW is really a term that we use, or that people in the industry use, in order to talk about what the differences are between at-the-money implied volatility and the implied volatility of strikes that are either on the call side or on the put side. Basically, what you're saying is, what's the difference between the out-of-the-money option and the at-the-money option, or the in-the-money option and the at-the-money option, as far as implied volatility levels are concerned? In order to talk about that, what you need to really drive home as a concept is basically every single strike in each month has its own actual particular implied volatility as far as the way that things are traded. And even within that, different prices that are traded create different implied volatility levels. So from that, what you can actually deduce is that SKEW is not only something that has a particular shape as far as what the curve itself looks like within the month, but it's also dynamic. It moves around a lot because different prices create different implied volatility levels. And if different implied volatility levels get created by different prices, you can see how SKEWs would move back and forth. Now, as you and I both know, and we're intimately aware of,
Mhm.
as market makers in options, we used to pay attention to SKEW very, very closely because there
Right.
was a lot of opportunity within trading SKEW back and forth.
Mhm.
The interesting part about SKEW, as far as the put side of things in equities is concerned, is particularly what you said before, which is there was a time when SKEW didn't exist.
I'd say even two, Matt. Sorry to interrupt.
No, go on.
Pre 87, there was almost a call skew then, meaning the upside calls were tilted higher than the same delta downside put,
Right.
because back then we experienced this big bull market and things only went up, and people were just buying calls, this new option product. I'll just buy some calls and make some money.
Yeah.
So it was almost tilted the other way prior to 87,
Yeah.
which is
Well,
pretty
I
interesting.
think that's a really interesting point because there's a couple of different things that have, as far as research is concerned, there's this guy named Chris Cole
Mhm.
from Artemis Capital Management who he runs a hedge fund out of Austin, Texas,
Okay.
and he's been producing papers since I don't know 2010, maybe 2008, somewhere around there. I remember standing in the SPX and reading this white paper that he put out about implied volatility. It was basically the first time I had ever read anything that someone had written that was about implied volatility as an asset class
Mhm.
that really spoke to like how it was actually traded, and it was written by someone who understood the actual like mechanics of how the thing worked. He's really great, a really great option strategist. He's a a really brilliant guy, but he recently did a kind of examination of SKEW. And to your point, as far as the call SKEW is concerned, he went back and went all the way back pre 1929 and looked at if you were to sell naked options,
Mhm.
what do you think the biggest losing naked option sale has been historically over the last 100 years?
Wait, so you're saying what do you mean which option? Like what, like an SPX option or what?
No. So just generally, and he looked across equities and indexes basically
Right.
in the equity market. If you were to sell, let's say, naked puts,
Yep.
naked calls, let's
Yep.
just start there. Over the last 100 years, over millions of iterations, do you
Yeah.
think selling naked puts or naked calls was worse?
I'm gonna. My gut tells me I should say naked puts because of the velocity of down moves and you get hammered. But I think it's probably, I don't know. It could be calls because the market's gone up, historically 8-9% forever. But
Yeah,
you can bleed your way out of that if it's not velocity based, right? You can kind of work
right.
your way out. So I don't know. I'm torn here. What's the
His,
answer?
well, his paper suggested that from his data, it was way worse to be short naked calls,
No kidding.
because of the fact that if you go back and look at the historical moves in the underlying, like in 1929,
Mm-hmm.
after the crash, the ensuing bull market was absolutely bananas. Like
Right.
the volatility, the delivered volatility numbers on the upside were almost as bad as or just as protracted as they were on the downside. But it went on forever. Like it went on for like 2 years. And
Right.
so you were getting moves to the upside that were just blowing through all of these, now back
Sure.
then, right? You're talking about 1929, options didn't exist in the way that they do now. And so what he actually did was he took the current SKEWs and overlaid them as if they would have existed back
Sure.
then. And then, right, pulled the data out of it.
Yeah.
But the actual underlying data does exist, right, for the indexes and for the individual stocks. And what it means is that in reality, there's a huge difference between, generally speaking, the implied volatility for the put side and for the call side.
Mm-hmm.
And that's the concept of SKEW, right?
Right.
The idea behind the fact that it's possible that you could sell the downside puts and even into a down move still be profitable because of how you hedge them is all because of the difference in the implied volatility of the, let's say, 25 delta put and the 25 delta call. And sometimes the difference is market, right? Because of how drastic the SKEW is to the downside.
Yeah. So let me. I don't know if you were going to share something. Let me try to share something here. Give me a second. I should have done this beforehand, of course. I'm not that smart.
Oh, yeah.
1 second. Oh boy, I need a window. This is the one I want to share. Are you ready for this?
I'm ready.
Do you see this?
Look at that. Look at how
Okay.
beautiful that is.
So I only picked 1 month, and this is Apple, and I picked a random. It looks like it's 4/21 is what I picked. So this is April 21 expiration.
Nice.
And the way you read this is the at the money's that kind of that big line, vertical line right in the middle.
Yep.
And each one of these points represents an option. Okay. Now the way we look at SKEW in our program, our platform is we use out of the money puts to determine implied volatility. That's this stuff down here beneath this current stock price. Sorry. And then we use out of the money calls to come up with this version. Now, when you see this way up here, these are little, we would call them teenies back in the day. These are little options that have no bid at a nickel and all that kind of stuff. This tends to be meaningless up here, way up here, and probably a little meaningless down here. Same deal on the put. So it should kind of tail out here, which we can do. But the bulk of the interest is in here. So this might be some 25 delta put. This might be some 25 delta call up here. And you can see the difference in implied volatility. This is IVOL from this put to this call, which is the same delta roughly, right? So what we're talking about here is that this curve started to skew to the put side. So the put volatility was higher. Now, one of the reasons, I think one of the main reasons, Matt, correct me if I'm wrong here, that this happened is I think market makers who are making markets back then discovered after 87, the crash there, that velocity of down moves is gigantically more enormous than velocity of up moves. Now you can get some pretty big up moves, but they don't scare the bejesus out of you to the upside. It's a pleasant kind of thing, and people are selling things to get out and take profit. So it has a little bit of a weight to it on those upside moves. Whereas downside looks like you're looking into hell sometimes, and you see this black abyss, and you're like, when is this going to end? So market makers smarted up to that, right? They said, hey, if you want to buy a lot of puts from me and hedge your portfolio, guess what? It's going to cost you.
Yeah.
Right.
Exactly.
Is that safe to say?
Yeah, I think that's safe to say. And I think what they and I think it was probably pre-87. I think the market makers probably figured out that people were just willing to pay a little bit more for the put side than they were for the call side.
Right.
And if you think about it, the natural order flow from someone who is long the underlying stock, which is generally, right? I mean, the equity market itself is designed for people to be long the underlying stock, right? That's how companies finance expansion and all of that stuff. They issue stock and people loan them money by buying the stock. And so generally speaking, the end user is long the stock. Well, if you're long the stock, your natural actual like order flow that you are providing to the marketplace in order to hedge your long stock position is to buy puts and sell calls.
Right.
And so what you get is if everyone's in there doing that, you are naturally going to see through, supply and demand are the two forces that run the prices of everything in the marketplace. The puts are going to be higher than the calls. Now, I think what we've done is we've looked back over historic prices and kind of ascribed to that the narrative that like the down moves are more ferocious in the equity market than the up moves are. And that I think is probably true, but I think it's a little bit more the reason why the implied volatilities are the way they are is because the people who make markets in the options figured out that like everybody wants to buy puts and sell calls. And so the prices are just different for the puts than for the calls. If everyone wanted to buy bananas and sell apples, the bananas would be more expensive than the apples, right?
That's
just like anything else.
Yeah. And I think it certainly makes sense. And I think the market makers kind of smartened up to it. Right. One of the things I was going to ask you is I think some of the prop shops, and what I mean by that is the dealers, the people who make the markets who we retail. Well, I'm a retail trader now, but we retail traders trade on the other side of, they probably have pretty scientific and mathematical statistical models that give them fair value for a SKEW in a particular underline based on a lot of data from the past.
Oh yeah.
So they can see when a SKEW is super steep or super flat, and they will take advantage of a SKEW that is flat versus a SKEW that is steep and make trades accordingly, or at least make markets accordingly, right?
Yeah.
And it may never get back to flatness, which I'm guessing it hardly ever does, if at all, anymore. When I say flatness, I mean the 25 delta put and the 25 delta call are the same implied volatility. I don't think it ever gets there necessarily, but my feeling is that Apple might get really flat and get closer, but not ever there. Does that make any sense at all?
Yeah, I think that makes sense. And one way, I'm glad you brought up the actual statistical kind of like the way that people keep track of the SKEW, because I think that's a really interesting kind of segue into how people might be able to use this data on a daily basis. I can say from experience that one of the ways that people generally use SKEW data like this is they go back and look historically at what those SKEWs looked like. For instance, for a 30-day option in XYZ stock. How many times over the last 30 days, or how many times over the last 10 years has the 30-day option been X% higher on the 25 delta put than the at the money put, right?
Right.
And they keep track of that. Generally speaking, a lot of people keep track of it by just looking at the vol of that 25 delta put and dividing it by the vol of the at the money put and creating what they look at as basically a vol ratio of those two options. And they keep track of it. And lots of people will actually look at it on a day-to-day, minute-by-minute basis and track that actual ratio over time and then compare it to how that looks over the last 10 years. Like, does this stock ever have a put ratio that is, 2-to-1? Is it ever 2.0? Or does it live between, 1.3 and 1.6? And then they'll track that, and then they'll actually trade that ratio based on where those vols are. And so I think that's really interesting. The other interesting thing that people look at and we'll talk about is the put versus the call ratio, the actual, what we used to call the risk reversal, which is theoretically the 25 delta put, not versus the at the money put, but the 25 delta put versus the 25 delta call, which is the exact same distance from a delta perspective on the opposite side of the price distribution. And so what you're really looking at there, and if you look at that SKEW graph that you had up before, you'll see that those actual options are kind of really interesting as far as where they fall in and on that SKEW curve. That 25 delta put, what was it, like a 50 vol or a 45 vol, something like that?
Yeah, this one, I don't know if this is the actual 25 delta, but it's a 30 something vol, 34 vol almost.
Yeah, and then the 25 delta call is going to be like a 25 or a 30 vol.
Yeah.
Right?
Let me see if I can nail that here.
It's really like,
so it's 34 versus 25.
Yeah, I mean, that's a big difference, right? That's a really big difference. And the at money vol is somewhere in between for this stock. It's like
31 and a half. So right in the middle.
Yeah. And so what people will sometimes do is look at these SKEW curves and say, where is the lowest point on the SKEW curve? Well, it looks in this situation
right about here, this 170.
Probably
about the, let me see if I can get that up here. But while we're talking,
like a 40 delta call would be my guess.
Yeah, something like that. So what was I doing here? I was doing the April. Sorry.
Yeah,
I was doing the April 21st. This guy here. So the 170.
What's the delta?
Is, hold on a second. We need a tick here. Oh, there it is. It's like a 34 delta thereabout.
There you go. Right. It's a 34. It's a slightly more than a 25 delta call, but it's right in that kind of heart of where that. A lot of times in equities, what you'll see is that dip in the SKEW happens on those slightly upside calls.
Yeah.
And that those calls. Now, think about it in terms of what we talked about earlier. Why would that happen? Well, it's supply and demand most of the time, but it's also a function of, historically, maybe everyone has been a seller of calls in that stock and those particular calls, or it could also be, that month itself might have just experienced someone who came in and sold a ton of that very strike. And thus that strike itself has been lowered on the skew curve. Now that's something that we also haven't really touched on, is from a market making standpoint, skew and implied vol are really kind of the only knobs that you have in your tool bag to be able to turn to change option prices. Implied vol generally will just take that skew curve that looks like this and move it up and down.
Right.
But changing skew, meaning changing strikes independently because of supply and demand of those strikes, maybe order flow, will change the skew to make it look like this, right? It moves dynamically up and down. When you have a function that makes a skew curve do this, this is called kurtosis. This is actual the wings themselves moving up and down.
Yep.
They can also move independently, right?
Yep.
Call side can move independently. The put side can move independently. And that's how people, generally speaking, that's where a lot of those opportunities for trades are in those, like, call 1x2s or butterflies that involve 25 delta calls. Those trades, if you start to look at them over a long period of time, will move in price terms as a function of how the skew moves.
Right.
And that's really interesting, right? They move as a function of how the implied vol moves on its own, but they also move as a function of, like, the calls get really, depressed because of a giant call seller. And then the call 1x2s end up getting really expensive because the at the money call doesn't move as much as those upside calls that start to lay down. So those kinds of trades are really interesting. And you can actually, by watching the skew independently, you can actually watch how those trades prices move as well.
Yeah, those are all great points. And I have a comment to make about that. So let's go back to the graph. So one of the things that the folks should understand too, and you made a great point about the flattening of the curve versus the steepening of the curve, and then vol moving with the integrity of the curve up and down. So there's a lot of movements that can go. But one thing that has to be in line, and maybe you can touch on this when I bring it up, is that can you see my cursor? Oops, sorry, right here.
There it is. Yeah.
Okay. So one thing, and Matt was touching on this, is that what typically can't happen for very long is, see this point where I'm pointing at right here? Whatever that is, that's the 120 strike, is it can't move up here without corresponding movement around it to come up with it. Here's why. There's something called a butterfly that exists down there, and among other spreads. And you can't have a butterfly that's so out of line that you can do it for even or a credit, because, obviously the market making community is just going to devour that if that happens. So and I call them sawtooths. So a sawtooth is like, see this down here? You got this one a little higher, and it looks like it's out of line relative to this curve. Now that can happen based on supply and demand. It can get whacked out a little bit. It can't go infinity whacked out because all the butterflies are going to be out of line. And then you're going to start doing things for credits. That's not going to work. Butterflies or credits. So what happens is you might have a little permutation where it hits that one particular option, knocks it out of line, and then it might take a little bit of a lag to grab the other ones around it, but they'll eventually, and it'll cause that steepening, right?
Yeah.
When someone hits one option, it's going to be a domino effect to the rest of them around it, right?
Yes, absolutely. And those kinds of things started to happen a lot faster in the late, I would say, 2010-ish, when algorithmic curve fitting tools started to get really introduced into the marketplace by big market making firms. I won't name them by name, but there are a lot of them that would basically, because back when Lex and I were trading options, when we first started out, the way that the curves would get moved is you would actually move them by hand. We would drag, like what his cursor was doing on that skew curve. You would grab that spot and you would drag it up until the option price itself would get to the point where you're like, oh, okay, now it's in line with the bid ask spread. Right. And then you would go through and be like, oh man, now these other puts are way out of whack. We should raise these. And then we'd raise these, and you would fit them. We would call them curve fitting. You would fit the curve. Well, what people figured out is, if I'm going to trade 300 stocks at the same time, there's no possible way that I can fit all of the curves and be able to assimilate all of the price data that's coming in from all of these different prints. I need a way to be able to just algorithmically have my computer fit the curves.
Yeah.
So what they would do is they would just turn their curve, their algorithmic curve tool on, and the curves would start to just do this.
Yep.
And
And the important thing there too is they would absolutely do that, but don't forget what we talked about just a little bit earlier. These market making firms have a statistical mean, or whatever you want to call it, that the curve should be. They have a value that is fair value in terms of the curve at large. And then they can tell, like we talked about a little bit earlier, when it's super steep, super flat, and they will take advantage of that, in putting on inventory, right?
Yeah, absolutely.
So this curve thing is really important to understand. I'm not sure how many retail traders pay attention to this. From my perspective at Tradier, we're trying to get this tool. This is TradeHawk. It's a powerful tool for understanding volatility and curves, and we there's some other things in here that are slightly more advanced. I'd say, but we can compute a theoretical curve, or a user can compute a theoretical curve and keep track of that. And you can see in the marketplace how it varies, steepness and flatness, right? And I would say in the trading days, especially when I was off floor more and we were using a system like this, we'd have greens and reds to define expensiveness being red, green being cheapness. So you go to lunch and you'd have a slight down move. And when I mean slight, it's a drift down. You know what happens to puts when it drifts down, especially skewed puts? They get hammered, right? So you come in and you see where your curves are set theoretically. Everything's green. All the markets are way lower than when you have it set. It's like, oh God, I'm getting killed today. These long puts that I have are not moving at all. So then you reset your curve and make it all look pretty again. Get the Christmas tree out of it, right?
Yeah. The interesting thing too, I think, from you mentioned the kind of the retail trading side of things, and how they don't necessarily people who are retail traders don't always look at SKEW. There is a part of SKEW that can show up even in things just like put spreads and call spreads, right? Because if you're trading put spreads and call spreads, if you're a put spread credit trader where you're always just selling put spreads, you have to keep in mind that you have two different trades on. You have one put strike that you're short and one put strike that you're long. Now, they're combined into one trade and they have defined risk because of that. But they have two separate implied volatilities because they're two different strikes. And so it's important for even the most basic of retail trader to really look at what those implied volatility levels are. And in order to do that, you need to be using, a tool like you just pulled up to be able to look at what the SKEW is of the 65 strike versus the 75 strike, because I'm short the 65-75 put spread. Which vol is higher, right? And sometimes things can get out of whack where, you can look at it and say, oh man, the 65 and the 75 put have the same vol. And generally speaking, the 75 put has a higher vol. Like, why am I still short this put spread, right? People can think about it in those ways. And the framework that you use to evaluate your risk can be based on how the SKEW is moving, right? Because those implied volatilities are moving around. And it's not just the price of the put spread that matters. Sometimes it is, right? But sometimes it's also, what are the actual implications of the implied volatility on the strike that you're short versus the implied volatility on the strike that you're long? Because those two things are different, and they're always going to be different, but you need to take a look at it and see whether or not that's still a trade that you want to have on if it moves significantly on one strike versus the other strike.
Right. Absolutely. No, that's all good points. I see we're almost running out of time here, Matt, but I want to introduce another topic, because that's going to be our next conversation.
All right.
And let me share my screen again. So one of the things I've been traveling around the country lately and giving this speech on what I'm going to show next, which is dealer exposure. Okay. Now this is a fancy graph. Now it goes hand in hand with the implied volatility conversation we're having, right? So what this feature measures is where gamma lies, and in this case it's Apple, but it's better to look at SPX or spiders, where gamma lies for the dealer. Okay, and this first graph is gamma exposure, and in these months that I have checked, gamma exposure is negative for the dealer. Okay, now I'm just going to introduce this topic. We're going to talk about it at another time, but There are something we call gamma clusters. And what's great for the retail trader is to understand where these might exist in the dealer community, because the dealer community hedges differently than the retail community. And the dealer community is a edge machine. They are making edge on every trade and hedging their trade. Their edge is captured in the bid ask. They can buy the bid, sell the offer, and they have theoretical value, hopefully somewhere in the middle, and they're making all this edge. But they develop inventory like this. And what's telling, the point of my story here, is that when you see these negative gamma clusters, you can get a flavor of what dealer behavior is going to be down near those negative gamma clusters, right? Because if it breaks through here, dealers are long. They got to sell deltas to get themselves back to delta neutrality. What does selling deltas do when they break through? It pushes that stock down more, right? So these are some of the things we've been talking about on our little escapades around the country with gamma exposure. And there's some other things on there that are sub-Greeks that we'll talk about on the next one as well. But it's interesting because this is starting to be a new study that I find retail traders are very interested in.
Yeah.
Any thoughts on that real quick before we bust out of here?
Yeah, it's one of those things that it's starting to become something that people talk about more, even on the retail side of things, because I think generally speaking, the overall understanding of how these things and the mathematics behind them work is starting to kind of permeate into the culture a little bit more. And that's, I think, part and parcel because of things that you and I do, right? Like the education aspects of what we do.
Right.
And what we're trying to do is really educate people as to what is really going on behind the scenes as to how the options work. And so in situations like that, where you're talking about a significant gamma exposure that exists in a marketplace, those things can be triggered by places on the SKEW where those dealer positions exist, right? They could be short lots of 25 delta puts or short lots of 25 delta calls.
Right.
And so if you understand the dynamics of how that works, you can understand a little bit better of how you might expect prices to move when you get around those levels based on how those positions work.
Right. Yeah, I don't know how you were back in the trading floor, but inevitably it wouldn't work this way. But I always wanted the opposite position of everyone else. But that was impossible to have because we're all responding to the same markets.
Yeah.
Now, as a retail person, you can kind of look at these gamma clusters and say, oh, the dealers are short there. I would love to be long there. Granted, the implied volatility is way too high for me to be, long gamma there. But it would be wonderful if that were the case, because now you can be opposite of what the dealers have to do and take advantage of those swings or lack of swings, depending.
Yeah, well, and oftentimes you can go and figure out a creative way to create that position without actually going and buying that specific option, right? You can, if you know enough about options, you can say, how can I create an option position that will just kind of throw off long gamma down there without actually being long that strike, right? And that's something that you have to kind of learn your way into. That's a pretty advanced topic, and that's something that from a market making side of things, people generally try to do in their market making positions. They try to tailor them in those ways. And not necessarily be long the highest vol on the board and short the lowest vol on the board, because that theoretically just gives you not the greatest of like positive potential outcomes. But you can go through and create an option position that does different things based on where you think those positions are. And I think that's really interesting. That's part of what we do as far as, being option traders is creating. The best part about options is how flexible they are. You can create things out of other things and make them, they're like Lego blocks, you can build up all these crazy positions, and they're great that way. So,
no, undoubtedly. All right, good. Well, I see we're over a little bit. That's okay. No big deal. As always, great to have you. I think, our background on the floor, especially the same floor, is kind of fun to talk about. It was a pleasant memory being down on the floor. I'll tell you, I'd go back in a heartbeat.
It was a pleasant memory, but I will say now today my knee is like all banged up, and I would not be happy about having to stand up all day and make markets.
We would sit down in the pit. They have those little tables now in the pits, the few that are left, right?
Also true, yes.
All right, Matt, as always, Matt Cashman, OIC. He's going to be a somewhat semi-regular guest, I would imagine, right? We're going to do this more often.
Yeah, I hope so.
Yeah, we have some great, I don't know if they're advanced topics or not, but great market making topics that are really interesting, I think, to the retail trader, and they should understand it, right? They really should. So,
Yeah.
Thanks for coming on, Matt. We'll stick around. We'll talk afterwards. All right.
All right. Thanks, Lex.
All right, man.